So the first thing from a tools for pitching standpoint is you need a forwardable email. We're going to talk about executive summaries, and we're talking about presentations in the 11 slides and kind of how you do those 11 slides. And then we'll take a brief break, and feel free if you need to grab something to eat or drink in the meantime, just go for it. So from a forwardable email perspective, you'll get this in the link, and again, you'll get an email and an invitation to Slack if you're not on Slack already tomorrow, but all of these links and all of these are live, and you can just use them from there, so you don't have to get too detail-oriented tonight. So Alex Iskold is the Techstars New York City guy, and he wrote a brilliant blog post on how to do a forwardable email, right? Which I had a great experience with at one point. One of my board members sent me a note and said, hey, would you mind introducing me to so-and-so? So, by the way, I'm Dave. Nice to meet you, Devlin. Would you mind introducing me to Devlin? And I'm like, well, no, I know Devlin, but I can't really explain your idea very well. So if you make it work for me to introduce you to Devlin, my answer is, well, I will, but I don't know when I'll get around to it. So I got an email from one of my board members that said, hey, would you mind introducing me to X? And I'm like, absolutely. And as soon as they sent him back a note, I got an email landed in my inbox saying, Dave, would you mind introducing me to Devlin? Our company is doing blah. It looks a lot like what you guys just did for the previous session. Our company is doing blah, and we'd like to meet with you for this reason. To which I had to just hit forward, Devlin, I think this company's doing interesting stuff. They asked for an introduction. Send. So the whole process took me a few seconds versus like, dude, I gotta explain your idea. I don't know where your idea is at this month compared to where it was last month. So one of the things you're gonna do is you're just gonna create a forwardable email. And I'm going to give you some tools as we get into this later. You're going to use HubSpot Free Edition because it has scripts and it has templates and it's free. And every time one of those ones come in, you're going to be like, template, boom, code, boom, forwardable email, done. Track Dave's email, did he open it or not? And you're just going to use HubSpot Free, and we'll talk about that later. But the idea with this is if you make it easy for the person to forward it, they will. If you make it work, and then you're like, why didn't they forward the email? The answer is, because it was work. And I already had shit to do before you asked me to do something else. So in my list of top 10, it didn't make the list, the cut, okay? So you also need to remember that as you're doing fundraising, your idea is going to be, you're going to meet with a junior associate at a venture fund. Their career at the fund is based on how well they can articulate your idea to their boss. Because I'm going to get asked by Devlin, my boss, he's going to say, so, did you see any interesting deals this week? And I saw Brett, and I walked away, and Brett was super smart, and he knew his market really well, and it baffled me. He knew the market so well that I can't repeat Brett's message. But Devlin says, did you see any interesting deals? And I really want to stay working at the venture fund. So I'm going to say, nope, I didn't. Right? And the meeting with Brett's walking away going, Dave really got it. Like, he knows my business. He was excited about it. And my answer was, I can't repeat it. So this is a little bit about the mom test. Like, can the person repeat your message? Keep in mind, in the fundraising process, which is an enterprise sales process, no one's going to write a check from your executive summary or your forwardable email. It's just the thing you do to get to the next milestone, to get to the next meeting, to get to the next slide, right? So all of them build in together. As an investor, I want to have a relationship with you before I write a check for you. So a random person who comes in, there are some investors in town who will be like, oh, let me just pull out my checkbook and write you a check. That is, let me know if that happens, because I know one investor, and I'm not going to tell you who it is. I know one investor who I know who's done that, but they're not writing checks anymore. And the reason is angel investors, angel investors go in and out of liquidity, right? So I sell a company, I have some cash, I'm like, I'm gonna write some checks, and then most of these checks take about 8 or 10 years to mature, right? To which my spouse goes, you're not writing another check, right? And by the way, that's the same boss I have to answer to, and if when it's not Devlin, right? Because Catherine will be like, what's the company do again? I'm like, I don't know, it's super exciting though. She's like, we're not writing a check for that, right? I don't know about you all, but we've been married for 31 years, and I'm going to try to get to 32, and I'm on an annual renewal. So not month to month, it's better than that, but I'm not, you still got to earn it every year, right? So Make it easy to get an introduction. Avoid buzzword bingo. I'm going to give you an example. This was my LinkedIn request one today. I have redacted the name of the person to keep them innocent, but this was my buzzword bingo of the day from yesterday. Hi, Dave. I run a socially responsible fintech that delivers disruptive lending products for sustainable financial inclusion using AI and mobile technologies to underserved market segments in the US and Latin America. I would like to connect with you. Thank you. Albert. Oh, I didn't redact that part. I got the two top ones.
Yeah, but there's a lot of Alberts.
Yeah, there's a lot of you guys know lots of Alberts. And it's in US and Latin America. I don't know about you, but I have no idea what the hell he's talking about.
Yeah, exactly.
Right? I mean, to him it makes sense. But for me, I'm like, I have no idea. There's a great Southern saying that says it's kind of the, if you have a bottle and you're trying to describe the label from the inside, it's really hard. Like Evian from the inside of the label, really difficult. Right? At the outside, you're like, it says Evian. But from the inside of the bottle, the answer is it's really hard. We as founders live inside the bottle, in case you don't know. So getting outside and making sure that we're giving a message that the investors can repeat for us really matters a lot. I'm sure this person thought this was a brilliantly well-crafted, forwarded email. No introduction. It didn't come from Mike. It didn't come from Brett. It didn't come from like, hey, Dave, I wanted to introduce you because I know this person. Would you make the introduction? So you can guess what my answer was to my auto reply on LinkedIn. So hyperbole is also bad. So I got an email today from somebody who I didn't post. I said, how's it going in the company? It's a person who pitched, by the way, Angels pitch, or the Founders Meet Angels before we went into summer break. It's fantastic. Okay, that immediately the meter is on. Like, it's fantastic. So maybe it is, and that would be awesome. But one of the things that happens in fundraising, and I want you to be in the top 10%, not in the bottom 90% of the fundraising exercise, and the way you do that is you come and you give a presentation and you're like, this is what we're going to go do and this is how we're going to go do it, with or without capital. Because then 30 days later, you're going to follow up with me, and if I happen to have your deck, I'm going to pull it up and I'm like, oh, you said you're going to be here. How are you doing? And if you're like, oh, we're crushing it, we're actually ahead of plan. Wow, I really want to meet with you. If you're like, no, the plan was dependent on you giving us money. Now you're in the 90%, right? So next time I will still take the call, but the question is how much progress did you make against your plan? If the answer is we're beating our plan, you're automatically in the top 10%. You will automatically get a meeting. But if you build your deck that is totally dependent on the fact that I need your cash in order to go hit these numbers, you're not going to get any progress on the fundraising side. So that's point number one. You start with the hypothesis that says, this is the plan with or without you. And then I'm much more interested in saying, well, what if it was with us, right? And you're like, oh, no, our forecast was X and we hit Y and our customers, this is what's happening. You have good news to tell. You're immediately in the top 10%. Okay, executive summary. Executive summary is 2 pages. That's it. For all of those who are founders, this is like pulling teeth, right? Because we're like, well, I know this and I know that and I have history in this and I have history in that. So I came out of a journalism background. I used to work for a company called United Press back before they failed a couple times. The analogy from a journalist perspective is you don't bury the lead of your story. The lead of your story is the thing that, so it used to be in journalism that you had copy inches, right? So you only had so many inches in the newspaper page. So if a breaking story came in, they'd start chopping off the story from the bottom. So if you buried your lead and it was in your 3rd paragraph, the story wouldn't make any sense at all, right? Because they just chopped your story. Yours is the same way, which is why we go back to that slide 10 that we had up for this slide. Hi, my name is Dave, and this is what I do. That's why I'm trying to get that automatic pull the string on your back so that you lead with that. Because what happens is then the investor can ask you interesting questions like, oh, really? Why did you get into that market? Where if, I don't know, well, I do know about you because I'm a founder as well. Founders suffer from proximity bias, right? Or recency bias. And what I mean by that is whatever the thing was that happened today, we're like, oh, we shipped the product. I'm like, I don't even know what the product is yet. oh, I had a developer quit. Didn't even know, like, we're so in the moment at times that I want you to get to where I pull the string on your back and you deliver my name's Dave, this is what I do, this is the market we serve, here's how big it is, right? So then you can keep the conversation going versus like people they'll do this and then they'll walk away from your networking event and you're like, maybe I didn't do a very good job with that. So just be on message, don't bury the lead of your story. So don't go off on market research or competitive changes that happen today. So the headline needs to tell the story. And again, it's designed to get you to the next meeting, not to get you a check. So what question, and I have this in another place in the deck too, but the question is when I finish my meeting with you, what questions do you want me to be asking? Is it, how do I get a check in the deal? Or is it, I don't know what you do? So, and nobody in the investor side wants to look dumb either. So if you say, hey, do you understand? I'll go, well, I won't. I'll actually give you feedback that's usually punishing in some cases. But most investors don't want to look like dumbasses, right? So human nature says, yes, I understand what you're doing. When the fact is, I don't have the slightest idea what you're doing. So the better approach is to say, many people that we talk to don't understand the market that we're in. So let me, you probably do, but let me tell you a little bit about the market we're in. Because you have to take from the suspicion that people just don't understand the market you're in. For many of you in the verticals that you're in, you have forgotten more about your market than I will ever know. As an investor, I have to learn a lot about your market super fast. So it's incumbent upon you to tease that into it so it becomes intriguing. Like, how big is the market? And you need to have a number in that. You need to have a hypothesis about it. And it's not everybody, or 10% of China. One of the things you're going to run into as you go through this as a process is your numbers in your forecast and the numbers in your deck and the numbers in your executive summary are not going to sync, which is a bummer. Because at some point somebody's going to look at it and go, which one of these numbers are right? And you're going to get feedback, and the feedback's going to point you one direction. You're going to change something in your exec summary and not in your slides. You're going to change it in your slides and not in your exec. So just be aware that there's some overhead associated with doing this, of keeping things kind of in sync. And just know that that's part of the process. All right, the deck. So normally I'm going to walk you through a normal format of a deck and a normal how you do a deck flow. But I'm going to give you some caveats to it here to make some sense of like when is it right to flip the deck around. So normally you're going to start with a problem solution, you're going to talk about market, and I'll walk you through all the 11 slides in the next slide. But I'm going to give you a couple caveats that are interesting. So one of the companies that pitched a few months ago that I looked at it was doing global supply chain logistics. I'm like, okay, that's a big market. I don't know much about it. I don't know if it's really a problem because I don't know the market, but it sounds really huge. And about slide 8 or 9, they introduced the founders and they're like, these two people are like brilliant in the space. Where should that slide be? Up at the front, not at the back. So what investors are doing is you're going through your slide deck, they're like, have I made money in this category before? Are these the right people to bet on? Do I think this is a big market or not? And I'm going through that checkbox in my head. And if the answer is, oh, it's business to consumer and we do business to business, or hey, I don't know anything about this market, or worse yet, oh my God, I've lost money in that space before, I have decided to check out. I'm out. I'm not gonna tell you I'm out, I'm just gonna nod and smile, but mentally I'm out. And at some point you're like, oh, and by the way, we're doing $30,000 of monthly recurring revenue a month. Also I'm like, oh wait, I'm back in. What were you talking about? Now I wanna rewind the tape. Right? So the general rule of thumb is you start with problem, you go through solution, there's a pretty standard format that you go through. However, if you have traction, you lead with traction. If you have customers, if it really is fantastic and customers really are coming on, I want to say, yay, yeah, lead with traction. If we have revenue, we lead with revenue. If it's a super complex market like the global supply chain logistics and you are an expert in that category, then your profile should be at the team should be at the start of the deck. Because now I have credibility that you're the team to go do this, and even if I don't understand the market, I know that Brett actually does. So that's one of the changes. The other thing to think about as you tell this story, and this one happens a lot, especially in the early stage, when you're like, our customer may be a one of these, and our customer may be a one of these. Like, we may be selling to IT managers, or we may be selling to global supply chain managers, whatever that is. And so what you do is you smudge that all together into your deck, and you tell 3 or 4 different customer scenarios instead of one customer arc. So what I would rather have you do, in my experience, is that you pick the customer you think is your #1 customer profile, and you tell that customer's story in context of what you're doing. So my customer looks like this. This is the problem they face today. Here are their alternatives. So problem solution in the context of the customer story arc. But don't give me 6 or 2 customer story arcs. Give me 1. If you find out in 30 days after you do more customer interviews that that is the wrong customer story arc, change it. Like, change the storyline of the customer. But don't, otherwise people end up bouncing around on their deck, and I'm like, who uses this? Who's your customer? What, give me context, because especially if I'm not the customer, I don't know. So the story arc should be a story arc that tells the story of, this is what my customer's life was like before. This is how amazing my customer's life is today. And this is why they will pay me money for this product. So when in doubt, if you tell my customer's life before and my customer's life after, that's a winner. So when in doubt, if you simplify that direction, and you're in a good spot. The last super quirky one is, like, make sure your contact info is on the, just in case you don't know, in your auto signature, you can actually put your phone number. It's crazy. I know today I'm ordering catering for an event I'm doing tomorrow night for a $1,500 order. It's not huge, but it's not small. And I'm like, can I call you and give you my, like, I'm not going to put my credit card number in the email. Like, can I call you? Is it like, how much more ink does it take on the email to, like, put your phone number in? Just make sure I know how to find you. Because your deck is going to be passed around. And you want to make sure that whoever it's passed around to knows actually how to get in touch with you. Sounds really weird, but it happens amazingly a lot. Here are your 11 slides. I'm just roll you through them. Yeah?
Sorry, just real quick.
Yeah.
Is there a way to see any, like, deck forum out there, like a platform that has other companies' decks? Or is that
Yes.
something that can touch on?
Yeah, so I'll have it in the supporting slides. I think it's in the supporting slides. There's always resources at the next to the last slide I try to include. But there's actually a list of like really awesome slides, some companies that you'll know, that you'll be like, yeah, that first deck was not awesome. Like the Uber first deck, not really awesome. But there's some great pitch decks, and if anybody else has those, so open invite, by the way. If you ever have input for slides, or have somebody who's like, there was a typo on slide 12, I'm like, awesome, tell me, because I'm store blind at this point, right? I can't see it. So if you have a list of those, but I'll make sure that it's in the list if I don't have it in that slide tonight. So your welcome slide is the slide that's going to be up here a very long time. It should have your tagline and say something about what you do. It should have your brand. It should have some design. It should look awesome. But when you do, whether it's a contrived event like a pitch event, like we're going to do next month, or whether it's a conversation with a venture capitalist, that welcome slide is going to be up a long time. Get something valuable out of it, right? So it should have your tagline, it should have your URL, a little bit of description or your brand. Then you're going to go into your introduction. Your introduction, okay, literally one time I pitched somebody going down an elevator. Not because it was like a GeekWire elevator thing, though that's happening now too. But the person was running late, they were double booked. He's like, listen, let's talk as I get to my car. And I'm like, oh my God, it's really an elevator pitch. Like genuinely in the elevator. So I have my 10 or 15 or 28 slides, right? Like every good founder. And I get one. So this is your rule of thumb. You should always have one introduction slide that if you don't get to any other slides, slide one is all you need. So I have a welcome slide, I have an introduction slide. If I never get to any other slides, everything's covered on that one thing. All my bullet points, target market, size, my story is there. So if I get to, I literally had somebody show up at a lunch one time who it had to be 50, 60 slides. And seeing the slides and seeing the lunch, and I'm like, I'm gonna have to only do 30 minutes. And I watched panic, right? Because it was like, I have so many slides. And I'm like, and I don't want to see them. That's the bad part, right? I'm like, just tell me what you do and how I can help you. So, so make sure that you do if you're going to do the 10-slide rule, that's great. Make sure you have one summary slide that tells your story, and it has enough prompts there for you to make sure you tell your story with that one slide. You're going to talk about your idea, which is in the context of problem solution. You're going to talk about market, which is how big is it from a TAM, SAM, SOM perspective, right? Total addressable market, service addressable market. And with that, and we've talked about this in previous sessions, so if you weren't there in previous sessions, you can go back and look at the video or look at the deliverables, but we talked about size of market last month. Who is your customer? And if you don't really know, pick one and be willing to pivot away from it. But don't come back and say, well, we don't really know who our customer is. Like, right now, given what I know, I have conviction that this is our customer. Great, it's as good as any other one, right? As long as you've done the customer development interviews. If you haven't done any interviews yet, don't go pitch anybody until you've talked to the customers to actually validate the data. Again, coming back to something I've talked about in the past, for those of you who are new, you have an opinion, I have an opinion. I have a checkbook. If you have data, you can change my opinion. But if it's just you and I talking about our opinions, because I have a checkbook, I win. So, but if you've done 100 customer interviews and you're like, well, Dave, you may not know the market, but I've done 100 customer interviews and 87 of the customers said they would buy it for this. And I'd be like, oh, tell me about those 87 customers, right? Because now data has trumped my opinion. That's exactly what you do for customer interviews, and that's why you do customer interviews. So you have to go out and do them regularly, and you never stop. So if that makes you anxious, don't do a startup, because you're never going to stop doing customer development interviews. So market, product, when in doubt, show the product, do a demo. Sometimes the demo is more important than the deck. Unless it's super complex, then schedule a different time to show the product. If you're going to get sidetracked on the product demo, be willing to do it later, right? Team, why are you the right team? Timing, why are the tailwinds behind you? How will you make money? So last month's session about pick your revenue model and know how you're going to make money and how you're going to market it. How are you going to build IP and a moat? And do you have a clear ask? By the way, this happens to map exactly to your self-scorecard from month 1. What? It's crazy. So if you have not done this yet from month 1, one of the things we did in the first month was this is our internal checklist that we use to evaluate deals. So we over-index slightly on a couple things. We over-index on market and team. So we weight the scores slightly differently for market and team. But for simplicity, what I gave you was a 1 to 4 scale. 1 being I hate it, 2 being I don't like it, 3 being I like it, and 4 being I love it. So this is a chance for you to score yourself on these things. Because what the investors are doing is they're scoring you on these things anyway. You just should know what they are. And your deck is going to correspond with a story arc, but include the answers to all of these questions. So if this is the first time you've seen this, awesome. Tonight, go home, score yourself. If you come in at a 2 in any of the 10 categories, you know what you need to answer in your customer development research or your work so that you don't land flat when you try to go pitch somebody. Because you have to answer all of these questions. It's just, there's no way around it. And when you don't answer one of those questions, a little red flag goes up in my head that says, I wonder how come they didn't talk about the size of their market. Either they don't know, and by the way, the size of the market usually includes competition, because we want to know like who's the competition for the market. And if the answer is we don't have any competition, that's when I usually run away. So if there's no competition, there's usually a no market. So again, session 1 notes, session 1 videos, session 1 slides. We went over this in detail, but for the Cliff Note versions, if you're new and this is your first session, go score yourself again and recognize that as you do your slide deck, those are going to be your weakest slides. Make sense? All right. All right, pitching. So we talked about doing your score again. So if you're doing an investor meeting, don't be overly structured. I want to have a conversation. The slides are just there to guide you and to make sure you've checked all the boxes. Like, did I address the market? Did I just, and you'll know that the slide, and Mike and I started our first startups together in 1998-ish. And one of the things, when your slides are on track, when somebody's like, so what about such and such? And you're like, oh yeah, next slide. Like, you're like, you've just hit the rhythm of like, I know what questions we've asked, right? So for my first startup, I think I pitched somewhere over 100 companies, 100 VCs. How many do you pitch for iCopyright? 30 or 40. So you're going to do a lot of these pitches. You're going to get in the cadence of like how a pitch goes and how a pitch flows, and just know that you're going to get a lot of feedback on your deck. You're going to make those changes in your deck as you go. When you're in the conference room table, use it as a way to moderate your conversation, but let the questions flow. Don't get overly structured. So. Pitch events, however, are this really wacky, contrived thing that we do, like Shark Tank Nation, right? That we are. So we have this contrived thing called a pitch event, and there's some great hacks to that. So if you have a 3-minute pitch event, so like next month we'll do 4 minutes and 4 minutes. So 4 minutes of pitch and 4 minutes of Q&A, where the judges will give you feedback. But if you have 3 minutes, you can cut something short and leave off things that you should be covering. Like, oh, I left off my financial model. Why did I leave it off? Because it was a really short pitch. And I know that you're going to turn around and ask me about, well, how do you make money? And you're like, oh, that's a great question. Let me hit the ancillary slide next. And you're like, oh, next slide. So just know that pitch events are a contrived thing, and you really need to make a little bit of a splash and separate yourself and be memorable without hurting yourself. Right? So, because some things you're like, yeah, no, that wasn't a good joke. That was bad. So shock and awe is useful if it's appropriate. If it's inappropriate, please don't. Again, coming back to the question, what do you want them to be asking when they're done with the pitch? Do you want them to be asking, what is it you do again? How are you going to build that product? Theranos is a great example of, can you actually build that? Which somebody failed to ask the question, and board members failed to ask the question. That one's wacky. Or the juice one that we talked about a few months ago, right? So I can either squeeze it with my hands in that bag, or I can put it in a $600 juicery thing. Do you really need to build that? So the question you want to be asked is, wow, that's really cool. How do I write a check to get into the deal? You don't want them to be going like, I kind of doubt your target market, or I think your competition is bigger than you think it is. And because I'll watch founders do hand wavy stuff, like, yeah, Microsoft's in this space, but they're not really concerned about this market, or it's like something super hand wavy, and you're like, I'm not actually sure that that's the case. Yeah, Amazon could move into our market, but we don't think they'll do that. Okay, so that creates a credibility gap for you as the founder coming into the dialogue. So the question you want them to ask is, so how do I write a check to get in? Or, and the way I would finish it if I were you as a founder is, what other information would you like from me before we meet again? Oh, I'd like to talk with one of your customers. Or, oh, hey, I'd like to understand more about how you're going to make money. So ask the question at the end. So the age-old euphemism or euphemism is probably the wrong word for it. The age-old saying in venture capital is, if you want advice, ask for money. And if you want for money, ask for advice. You're building a rapport and a relationship with somebody who you've just met, and you're asking them for generally a sizable check. Our average check is somewhere between $500,000 and $750,000. So I'm going to talk with you about due diligence here in a little bit, but the process is I really want to get to know you and see that you're consistent and hanging out and not a flake and not crazy or something like that. And then I want to figure out if I can tell your story and figure out what our next meeting should be. So if you finish the conversation with, so have you seen anybody else doing something like this that's interesting, or what information, what data would you like me to have for you next time that we meet? Like, that's a great question. I'm going to want to know customer information. I'm going to want to know product information. Are you making progress on shipping and doing updates? Versus if you don't have a clear ask at the end, I know you have an agenda. It's okay to tell me what it is. That's okay, right? And people who are like, nope, didn't really have one, don't really have an ask. Why are we meeting? So just be clear about what it is. It will help you. Okay, So let's go to fundraising fundamentals. So the concept here is you have stage appropriate capital that's the right money for the right time. So we have some big funds here in town, folks like Voyager, folks like Ignition. So Ignition's smallest check these days is $5 million. For $5 million, they want 20% of your company. So anybody doing pre-money, post-money valuation calculations in their head? Anybody not know what a pre-money, post-money is yet? All right, so if I'm taking 20% of the company, I'm writing a check for $5 million, what's the value of the company? $25 million, okay? So in order for a big firm, if we raise a big fund, I have to write big checks. So Ignition doesn't write a check less than $5 million, with minor exception. And the minor exception is somebody like us comes along and says, hey, we're writing a check for this deal, and we're syndicating it out, and we have $1 million left. And it's like, we like that deal. Like they do B2B, they do big checks, and they want 20%. But when they take their next round, they're going to keep their 20% going forward. So if you're looking for $1 million, and the smallest they write is 5, is that a good meeting for you to take now? Nope. Will they take the meeting with you? Yeah, they'll take a meeting with you if you're doing something interesting, because they want to meet you early, and they're trying to build a relationship with you too. But if you walk away from the meeting, you're like, that was a great meeting. Dave was so wrong. They loved me. They're still not going to write a check. So they may have loved you, and I may be wrong. But generally speaking, stage-appropriate capital is what it matters for. So let me flip that to the other side of the scale. Early friends and family money is the most risky capital that you can take, because you don't really know yet if this is an awesome idea or not. So if your aunt or your uncle or your grandfather writes you a check, they should have the best terms of anybody that you give terms to. So the best, most great terms. So within venture capital and fundraising, there is information asymmetry, right? So as you get more mature in it, I know more about valuations than you do, but when you're early to it and your grandma doesn't know anything about raising capital, you have information asymmetry in your favor, right? And every once in a while I'll see a term sheet and I'm like, wow, the angels got really a bad deal on this one. Makes me wonder. So there's a set of there's some great docs, and they're listed in the resources tab as well. But early angel investors should get the best deal. We're investing other people's money. Doesn't mean we don't want a good deal, right? But your friends and family, because you're going to show up during Thanksgiving, they should get the best deal. So make sure that information asymmetry, you're educating them to it, because otherwise Thanksgiving becomes super awkward. Then you move to angels and VCs, and we'll break down each of these categories: large stage venture funds and private equity funds. The bigger the check is, the more they're making a financial return decision versus a risk capital decision. Our stage of a seed stage investment, we're betting on you and the market. Maybe you have some traction, but you probably don't have growth revenue yet. Like if we put $10,000 in today, how many days would it take for us to get capital back out? Yeah, you probably don't know that yet. But when you get to private equity and big checks, the answer is we want to see your financials. We're going to spend a lot of time on financials. The other thing that happens with fundraising is you get control shifts, and parties are interested for different things for different reasons. And I will tell you that shitty boards produce shitty enterprise values. And people who don't add value to your board, you need to not be overly ambitious with how quickly you say, hey, we'd love to have you join my board. The answer is, we just met. You shouldn't ask me that question. That's really bad. And I may be a really good board member, and I think I am, but I still don't know your business, and I still know how to add value to it. So the more the company sells of the company, so every round of funding you raise, you're going to create new shares of stock, and you're going to sell between 20 and 35% of your company for every round of funding you raise. That's just a rule of thumb. So your seed round, your pre-seed round, first, friends and family, 20 to 35% of the company. You may do that in convertible debt, totally fine. We'll get to the mechanics here in a bit. But you're not selling your shares, you're creating new shares that you're selling, and you're going to sell roughly 20 to 35%. Then the seed round comes, and we're going to come along and say, we want our 10%. We typically write a check for 750. Back of the napkin math again, 7.5 million post-money value, right? So do we write a lot of checks for stuff that's $1 million value? No, too early for us, right? So all the investors are kind of mapping my average check to the size of the equity into what I want to own. And you just need to know that angels look at it one way, and early stage VCs look at it another way, and late stage VCs look at it bigger. So if you do the back of the napkin math on this one and you do 3 rounds of funding, how much dilution is your company going to take? A lot, right? Could be 100% of additional dilution. So if you have, let's keep the math simple. If it's 5 million shares that you and your co-founders have to start, and you sell another 5 million shares, you went from having you and your co-founders having 100% of the company to now you and your co-founders have 50% of the company. And depending on how you have it split up, some of you may have single digits. So the reason I bring this up is you want to know this going into it. So I was with a founder not too long ago who they were at a point of exit, and I'm like, that's awesome, congratulations. And they were like, yeah, I'm down to less than 7% of the company. And I'm like, dang, 10 years of work, that's a lot of work. So you need to be aware of that. Yeah?
But that 7% is still...
It's a bigger pie.
2 billion shares.
Yeah, it's a bigger pie, right? And the company's worth more from an enterprise value for sure. But again, you just need to... the implications of it are, especially if you get a down round, or get a cram down round, or the market bubble hits, or like there's things you look at and you're like, that was a lot of work and I didn't actually earn much. So just, I tend to be founder friendly, and I think some of you have heard me say before that I had a VC say, I don't know if you can not be founder friendly enough to be a good VC, which for me I took as a complete compliment, like the best compliment ever, right? Because you all should know this before you go into it. So that's your dilution. So that's the 101. So let's talk about angels for a minute. And angels invest in you and your passion. They may not understand the market or not, but they're like, I love you and what you're doing is really cool. That's kind of fun. And there's a great group on Mercer Island that meets at the south end of Starbucks Mercer Island, and they just look at deals all the time, and they look at them super early, and they're like, we like that founder. We think that idea is kind of cool, right? By comparison, they do no due diligence compared to what we do, like none. And that's okay, because there's some rich guys who are like, yeah, we like you. And you came from, and Dave referred us in, and Dave thought you were good, or whatever the introduction was. They may or may not know the market. They may or may not have made money in that sector before. And they like to talk about cool stuff at a cocktail party. So it depends on, again, what their motivation is. They're writing the earliest checks, and you're talking about 10 years to maturity. So on average, from venture capital, from institutional money, the time we put money into, the average exit is 7.5 years. So an angel is putting money in a year generally before us. So they recognize that they're going to write a check, wish you well, hope you do all the good things you can possibly do, and they'll see you in 10 years, maybe earlier. Deal types they're going to see. They're going to do convertible note with a cap. A convertible note with a cap basically is a debt round of funding that prices the maximum price at a future date. So a very common convertible note with a cap is we're raising $500,000 on a convertible note with a cap of $3.5 million. So what that means to me as the investor is if you really do well and you decide to go out and raise money and you raise $2 million to Dave at a $7 million pre-money value, as an angel, my round is capped at 3.5. So I get twice as many shares as the venture capitalist gets because I invested super early with you. The great part about these docs is they're really cheap and they're easy to do. And if you have a venture lawyer who doesn't understand this, run away and find a new venture lawyer. I'm happy to refer you to some. Some of them are in this building. These docs are super cheap. They're accessible online, and they're easy to do, and they're fast to do, and they're inexpensive for you to do as a document. They want pro rata participation, which means if I bought 2% of the company now, and you go do a next round of venture capital funding, I get the option to put in more money to keep my 2%. Now I have to put in the money at the valuation that the VC is putting in it, which means I may need to stroke out a bigger check, but I want to know that I have pro rata rights. And you'll find that a convertible note without a cap or non-participating, non-pro rata rights tend to be deal killers for angel investors. So the middle of the fairway deal for you is convertible note with a cap, pro rata participation. And again, these are super vanilla. You can find them at Series Seed docs from Cooley. And basically what Cooley did is they posted all of these docs on GitHub. So you can literally go get complete, downloadable, open source. Everybody uses the same docs. And again, if your lawyer doesn't know this one, yeah, ask me. I've spent a lot of money on lawyers and I've learned a lot, and I should have just got a law degree. So notes on angel groups. So here's the deal. All of you are doing something that goes completely against the crowd. So the money I have made with startups was from doing the absolute opposite of what everybody else was doing. So as an angel investor, I don't really hang out with a group of other angel investors because that's not kind of my thing. Now, if I'd made a lot of money at Microsoft or Amazon and I'd never been a founder, then hanging out with a bunch of other angels is actually kind of cool because I know there are other high net worth individuals. They kind of have stuff that like me, and I don't know enough about investing or fundraising to actually do anything other than write a check. So angel groups can be super helpful if two things happen. I have a lead investor, where somebody is willing to set the terms of my round, right? Or somebody I can name drop, where I'm like, oh yeah. So how many of you met Javier Soto? Okay, so Javier's been here. This is like the first time he hasn't been here in like ever. So if you said Javier's in my deal, I'd be like, oh, that's really interesting because I know Javier has a standard by which he invests. And if Javier's looked at your deal and he's in your deal, then I don't have to do that work. I can just write a check. So what you want with an angel, if you have a lead investor like Javier, somebody you can name drop, ask for permission first, by the way, in case there was a question. Because everybody knows everybody in this community. And it's not just this community. We do a quarterly angel call. I'm sorry, a monthly angel call that I dial into, and I will hear, oh yeah, I saw this deal. And somebody will be like, yeah, we saw that deal too. We thought it was, the valuation was high. And everybody goes, uh-huh. So you're like, well, I tested out this valuation and because I didn't figure it could hurt me. And the answer is, oh yeah, it hurt you. Right? Well, we decided instead of doing a convertible note with a cap, because Dave said so, we decided to do a convertible note without a cap. Or we made our cap $6 million instead of $3 million. And I'm like, oh. So we're actually talking about you behind your back. Just like you all are talking about who you met for angel investors and was that person a good person or not. So if you have a lead investor, angel groups are great. If 50% of your round is raised, angel groups are fine. You typically won't find a lead investor at an angel group. If they ask you to pay to pitch, just run away. KeiretsuForum.com. So they do some really good things for like real estate fundraising and some other stuff. And they've written some great checks in town, so I don't want to take that away from them. But for you at the earliest stage, you just need to know that in order for you to get great value out of it, you have to have half of your round raised. Because people will pile on and help close the round, but they're not going to help lead the round. And you shouldn't be paying money to go to 6 different cities at $1,500 a city at the stage that you're at. So if you have a question about it, you have my email, you can always ask. There's another group in town that they're training angels on how to be angels. So they do super aggressive Series B level due diligence on 10 people putting together 10 $5,000 checks. Super painful. So maybe you want to do that one, which is fine. But just know that their level of due diligence and the questions they're going to ask are disproportionately high for the checks that they write. So something important to know. All right, early stage risk capital VCs. So I don't invest my own money, I invest other people's money. We have a limited partner agreement. Our limited partners have a charter that they wrote a check to be a participant in their fund. So I invest to that charter. So if your company is not in our charter, we're not going to invest. It has nothing to do with you. It has nothing to do with your traction. It has nothing to do with how cool your product is. It has to do with the fact that we raised money from Dan, and Dan says, why did you invest in that deal? That's not in the charter. So we invested in an ICO. Can't do that. We can only invest where we get equity. We can't invest in coins or tokens. So we have a whole set of restrictions around what we can and can't invest in. So what you can do is now you can go to Crunchbase or AngelList, and I'll give you the whole list of them here in a couple slides, and you can do due diligence on what was the last check that Dave wrote, or Seven Peaks wrote. It's not technically me. What was the last check? How big was it? What type of company was it? And if they've never written a check in a deal that looks like yours, they're not going to. So that's just, right, it's too risky. If I don't know, if I can't compare it, it's too hard. So stage, vertical market, size, and geography. If I'm Ignition and it's a $5 million check, I just can't write a check that's that small. If it's outside my geography, like we look at deals and it's like, that deal's in Boston. I can't get on a plane to go to a board meeting every quarter to do that deal. Not gonna do it. Is it a bad deal? No, it's just in Boston. And you have to remember, VCs are generally lazy, right? Sometimes assholes and lazy, hopefully less of that, but yeah. We are always looking for a deal that will return the fund. So we tend to look at it in quartiles. Is this a deal that will return the entire fund? So our fund right now we're investing is it's fund 2. It'll be 25 to 30 million by the time we're done raising it. So we're looking for, if we invested $750,000 or $1 million in a deal, would that get a 30x return? And if the answer is no, then the answer is, it's probably a good, interesting deal for somebody, but it may not be an interesting deal for us. Is the deal going to get me a 4x or 5x return? Do I want to invest in a 4x or 5x return? Not generally, because of the deals I'm going to invest in, a bunch of them are going to go bankrupt. They're going to be worth 0. A number of them are going to return 4 to 5x. One of them is going to return the entire fund. So what I'm doing is I'm doing arbitrage as we're looking at how we're putting together our portfolio. Is this a really great deal or not? Is the market super huge or not? And if you didn't explain it to me so I understand it in that context, then we missed the point on the pitch deck, right? Which is like, why am I doing this? So there's also in the sense of the early stage, we're right in the midst of, you have a little bit of revenue and traction, but you haven't really scaled it yet, and we're trying to figure out like how do we help you push that together and really scale it up. So that's why if you don't have product or you don't have revenue, it's super hard to get funded by anybody other than friends and family, right? Because if we're looking at it, half of our early, so quick fun dynamic for you, we're out raising money, and so every deal we do before we close the round, all of our investors are like, is that the normal type of deal you're going to invest in? Is this like indicative of the fund? So of our first 6 deals, 3 of them were pre-revenue and 3 of them were post-revenue. So every deal we looked at, we're like, how does this look to the investors who were waiting on to write a check? The other thing you have is the stage of the fund. So early stage funds like that are super critical of what the deal is, but once the capital's there, we'll tend to be faster about how we deploy the capital. The way funds work is we ask you to commit a dollar amount, so let's say it's $500,000. We'll send you what's called a capital call. And the capital call basically comes back and says, hey, we need to do a check for this. Your participation on it is a check for X. Even though you may have committed $500,000, we're never going to ask for generally more than 75% of it, because we're going to keep 25% of it for later stages of that company we want to invest in. We don't want it on our balance sheet because it drives our internal rate of return down, and it makes the fund look like it's producing a worse return. So we're going to do capital calls. So from a fund perspective, as I'm at the end of my fund life, am I going to take a super risky investment with the 25% I have left? Nope. I may try to make a couple small bets and see if I can kind of parse the deals out, but am I going to make a big bet on a company at the end of my fund life? So when you're out talking to VCs, it's good for you to know, hey, listen, what geography do you invest in, and what size, and what stage, and where are you in the fund's life? If the answer is, oh, we're raising the next round actively today, the odds of them writing a check while they're actively raising a round are pretty low. We do, but it's really hard because you're focused on we're out raising money too. If you're like, yeah, we just closed on the fund, the answer is right timing because I'm ready to write checks. Not willy-nilly, right? We still have a disciplined approach to it, but versus I'm at the end of fund life, I'm not gonna do it. Later stage equals growth capital. So if you think of risk capital and growth capital, risk capital is this may or may not work, it's kind of binary. Growth capital is you're already working. What would happen if we put $1 million into growth and sales and marketing, and how long would it take you to get that return? Big funds write big checks and do growth. So my partner in the fund is Tom Gonzer, who is the founder of DocuSign. Over the course of DocuSign, it's a classic 14-year overnight success story, maybe 15. Their last round of funding, they raised $250 million before they went public. Tom's like, that was the easiest money we ever raised. It was strictly a financial decision. There wasn't like, well, the people going to use this DocuSign thing? Like the early days was like, is it legal? Well, is it okay to have an electronic signature on a document? Right? The questions completely change as you have traction and growth. So just be aware that later stage, the problem with later stage venture capitalists in particular is they'll take a meeting with you because they want to know what's happening, and you're like, oh, you're really interesting and what you're working on is interesting, and you're like, do you write checks like this at this stage? And if their answer is no, say, great, I'll keep you on my email list, and when it's appropriate, we can reach out and connect. Because otherwise, it's tough. So MBAs calculate their returns, cash-on-cash returns. Strategic investors tend not to be valuation sensitive, but they can corrupt your cap table. So let's say you're doing something in healthcare and Merck comes along and says, we'd like to write a check at super early stage. And you're like, the other customers are like, I don't know if I want Merck to be an investor in your company or whoever the competitor is. So they're making bets that are relatively small bets to say, I think I know where you're going to go in the future and I want an early look at it. The other thing to be careful of later stage companies, there was a trend a few years ago where big, super large venture capital funds would come around and write early stage checks for like, we'll close out the round for $100,000 and we'll close out the round for $100,000 in your deal and your deal. And then you would go to raise the next big round and they'd be like, we're out, which is horrible signaling, right? Because somebody's like, wait a minute, why are they out? So it was like, well, it was kind of an experiment. It's like, yeah, but now you're signaling to the market you don't want in the deal. So again, things you need to be aware of later stage, but something to log away in the back of your head. Fundraising process, this is an enterprise sales process. Anybody do enterprise sales before? All right, for the rest of you, the enterprise sales process is, I would liken it to landing multiple planes at the airport at the same time. What you're trying to do is line up a bunch of investors who could align at the same time to create at least a sense of momentum and a reason to close, not a sense of a reason to wait. So the process is, how many opportunities do you have at the top of the funnel? It's up to you to do the research to find the funds who invest in your type, stage, and geography of deal. You can go to Crunchbase, that's cheap. You can go to PitchBook if you want to pay any money. You can go to AngelList. And what you're going to go look for is, what are other deals like mine at this stage? And the email you're going to send out is, hey, Mike, I noticed that you invested in XYZ company a few years ago and it exited. I was curious if you could tell me from your experience what you learned watching that company grow. Again, I'm asking for advice, not for cash. They don't know you. So reach out and say, tell me what you learned. And what you want to do is create that email script that basically is the start of the sales process that introduces, my company's doing X. I noticed you invested in Y company. I'm curious what you learned watching them grow. And most of the time people will be like, oh yeah, I'd be happy to talk with you. Maybe it's a phone call, maybe it's coffee, but it's like, what you're after is, what can I learn about their stage? You're going to create the forwardable email that we talked about. You're going to ask for approval, and then you're going to start building your email list, which is I get done with my meeting and say, hey, can I put you on the email list with my regular updates? Most everybody's going to say yes. If they say no, you know that you don't need to call them back as a potential investor. Right. So those are resources. I would suggest that you do the research before you meet with the investor. You can go to AngelList and see every deal this particular person invested in. It'll give you insight to stage and timing and type of deal. Right? So that's your process. You're going to run like enterprise sales, and you're going to have a lot more prospects than you plan on, because not all of them are going to close, and there's lots of reasons for people to wait. What's a good target investor? Go to their LinkedIn profile, ask for the email introductions. Do not send the cold spam ones over about your buzzword bingo. You're going to figure out whether they have board experience or stage experience. Do they add value other than just capital? If you can bring somebody onto the company as an investor who could potentially be a board member who adds value and not just money, that could be a double win. You start them as an advisory board member, though, because you don't know them well enough to ask them to be a board member, or vice versa. If somebody's writing you a check with anticipation of getting a job, run away from that check as fast as you can. That's never a good sign. And then can they help you with other things? Can they help you get other introductions? Can they help you recruit? Can they help you get other investors? And be willing to ask for that. I think one of the ahas is founders tend to go dark, right? So we're very heads down, we're very focused on what we're doing, and sometimes it gets hard. I'm actually for you, not against you. Like, we wrote a check to be in your deal, I'm for you. So if you don't tell me you need help, I don't actually know. I'm a horrible mind reader. So, but if you say, hey, I need help, the answer is, I'm happy to roll up my sleeves and come help. But I need to know. But founders tend to go the other direction, which is, oh shit, this is not good. I need to figure this out by myself. You are not always the smartest person in the room. I think we've moved away from the Steve Jobs era, hopefully, where it's like all smart ideas need to come from one person. And there's a whole bunch of figurative scars on my back from being in your chair before. And if I can help you not get some of those, that would be awesome. That just feels like a good reason to give back. So make sure that you tell us when you need help, because if you don't tell us, I don't really know. First impressions matter, and you're in control of it. So there's some rookie mistakes here that are just awesome. So I was meeting with a company the other day, and they're going from 0 to 300 million in revenue in year 4. The good news is that puts them at the #1 Inc. 500 company over the last 10 years total. So know that what I love about it is, like, I love Excel, right? Because you can just add one little thing and one little percentage of growth, and like, we're at $300 million in revenue in year 4. It's amazing. So just be aware of that if your valuation is too high. So if you have lots of money, lots of traction, and lots of customers, and things going the right way, great. You don't actually have to pick your valuation. You can wait for my feedback or your investors' feedback to kind of gauge, like, is this the right stage of deal or not? Hey, what do you think the pre-money value is? I don't really know yet. I'm focused on growing the company and growing revenue and shipping product. I love to hear that, right? Because I'm looking for, how do we price it, and is it out of the price range? But there's a deal that I know I looked at again recently, who finally came down on their valuation. But in order to come down on their valuation, they had to reprice their earliest investors, which was, by the way, the smart thing to do, because that was the friends and family money. So they went out and raised $1 million from friends and family at a valuation that was too high. And then they brought it to us, and I'm like, your valuation's too high. And they're like, well, we think, I'm like, that's great. I'm glad you think that, but I'm just telling you, for us, we want to get 10% of the company, and we write an average check of X. So we're going to pass on you. It has nothing to do with your deal. It has to do with, that's kind of our economics. That's what drives it. Family members on the team, yeah, that one's hard. It's a compounding risk factor that we tend to step away from. I looked at one a couple weeks ago, husband-wife team, didn't tell me until about halfway through the presentation. I'm like, that makes it even awkwarder, if that's a word. Because I'm like, it feels like they're husband and wife, but they didn't, like, you feel like I should lead with that at the start of the presentation? Like, hey, by the way, we're married. Okay, that gives me context. Versus like halfway through, I'm like, so are you guys married? Oh yeah, we usually lead with that. I'm like, that would have been a good thing to lead with. Because for the last 3 slides, I'm thinking, like, he keeps interrupting her and she has really smart stuff to say. That's weird. Yeah, it's just weird. So yeah, we usually lead with that. I would lead with that. So I don't know what happened in the last 3 slides, by the way. Because I'm thinking about something else, right? It's never good. Hairball on a cap table. So you have, if you weren't here for session 2, when we talked about awkward co-founder discussions and reverse vesting schedules, this is a great example. We had 3 founders. There's now just 2 of us. One of them left to go back to work at Microsoft because he needed a job, and life happened. Great. 32% of the cap table is now with somebody who's at Microsoft in a job. Are you going to need to replace that person? Yes. Do you have equity to replace them with? No. So is part of my money going to use to buy him out or her out, or to pay for your future? So you just need to take care of those things before you have a fundraising event. Because when it comes up with this, I'd be like, go take care of that, and then let's talk. Just so you know. So weird cap tables are bad. You can fix them, but weird cap tables are bad. So bad first impressions will end up having people talk about you on that conference call I was talking about earlier. All right, from a process standpoint, we talked about asking for cash versus asking for advice. One of the things I'll tell you about venture capital versus angel investors, you can do what's, we kind of call it a party round, which is a bunch of people write small checks and you'll like rally the checks together. When you get into a venture capital deal, what usually happens is we pull a deal versus you pushing the deal. So if I like the deal, I'm gonna pull it along. I'm gonna keep it going from a momentum perspective. But if you have to call me and nag me about, hey, it's me again, it's probably just a weird dating relationship where I'm not gonna call you back. Now, again, my thing is I like to actually give you feedback and say, look, here's what I'm thinking is probably what other investors are thinking, but I'm going to tell you that so you don't walk away going, oh, that was an amazing meeting, I should keep following up with it. Versus if we really like the deal, it's really how do you create momentum to close a deal? And the answer is, I've got somebody over here who may lead, I've got somebody over here. So I'm always creating a reason to close. So let me give you the contrast. There's some reasons there's some things that you do that create a reason not to close. Like, hey, we're shipping our next new product in 30 days. Awesome, call me in 31 days. Actually, probably 45 days, maybe 60, because it's 30 days after you ship it, I wanna know how the customers liked it. So you've given me a reason to wait instead of a reason to close. Hey, our big customer is finally getting ready to sign on the deal. Awesome, let me know when they signed. So don't hide the ball, but create a reason to close. And you can do what's called a first close and a final close, which is we're gonna do a first close, we're gonna take $1 million, and then we're gonna do a final close. So you're creating a reason to close, which is just an important option in your proverbial world, okay? We talked about finding a lead already. So let's talk about just process here, just from a mechanics perspective. Anybody use HubSpot? Okay, anybody not know what HubSpot is? Brand new, okay. So HubSpot is a free CRM-ish, it's free on the marketing side, and basically it's a plug-in to Gmail, and you can automate a bunch of tasks, and you can know when people open your email. So basically if you sign up for a free account on HubSpot, they have some good tools for early stage founders. You plug it into Gmail, you configure it, it's free. You add templates, you add follow-up emails, you add calendar tools. So everything that you're doing that's saving you from cutting and pasting the same redundant email that you're going to do over and over again, HubSpot just does for you. It also gives you a way to track those things. So you're going to create a contact type, and it's going to be investor target, investor contacted, investor qualified. You're basically just creating a process that you can turn around and follow. And you're like, I talked to this guy named Dave. I don't remember what his last name was or what firm he was with. Again, top of the funnel is lots of people, which means there's not one perfect investor for you, right? The question is you want to find a lot of perfect investors for you and then choose. Optionality is good for you. If you have nobody else who's going to invest in your deal, I probably won't write your most preferred term sheet. I think I'll write a fair term sheet, right? Because the reputation gets out that you don't write fair term sheets, that's bad. But if you're like, ooh, somebody else is, I'm going to get a term sheet, don't lie. I'm going to get a term sheet at the end of the week. Then I'm like, I got to get on this. Or if you're like, we're still talking to a bunch of investors, and all I hear is I have reasons to wait. And by waiting, I'm de-risking my investment for my investors, which is not what you want to hear, but it is what my investors want to hear. So you're going to create a process, you're going to create a contact type, you're going to track the opens. You can either attach your executive summary. Don't send the deck in advance, just send the executive summary. So the email and the executive summary should be enough to get you the meeting. If they want to see the deck in advance, schedule the call, walk me through it. Ideally, you want to be face-to-face. But if you're not going to Silicon Valley for that one meeting, and my counsel there, if you decide to get on that one is book, I'm going to be down in 2 weeks on Tuesday or Thursday, which day works best for you. As soon as you have the first one booked, then you book around it, right? Because you don't want to be flying back and forth and spending a lot of money on stuff that you shouldn't be spending a lot of money on yet. Okay? Some people like to do a link because they want to know if there's tracked and opened. It's up to you. I like to forward documents around to the team. I typically take the document and drop it into concurrently to this, we have, well, let me finish on this and I'll tell you what's happening on the other side. So I use a tool called FreeBusy. It's cheap. You can use Calendly. The reason I use FreeBusy is I have at least 3 calendars that I have to sync to make my calendar link available to somebody to say, hey, I want to book a time with you. So my Calendly doesn't work for that because it only does one calendar. I have at least 3 calendars I need to sync. Like, do I have to be home for curriculum night before I meet with you, or like what's going on in my world? So my least favorite one is Zoom meeting has a free version that's limited to 45 minutes. We're finally having a good conversation and you're like, my Zoom meeting's coming to an end. Like, for $15 a month, really? Pay the frickin' $15.
Yeah.
Just pay it. Email Tracker Pro is a Chrome extension you can use if you don't want to use HubSpot. So again, first impressions drive the process. Don't wait for me to drive the process. If I say, yeah, I'm interested in a meeting, send me the calendar invite. Use the link on my calendar. Right? Don't wait for me to set it up, or you own and drive this process. That's why it's a sales process. Meanwhile, this is what's happening on our side. I have this massive spreadsheet of early stage companies. So in the last 12 months, I've looked at 158 companies. Super early, right? Some of you all count in that category, right? They have a name, they have a product, they have blah, but I'm tracking them. I'm keeping an eye on them. There's companies, and I rank them and score them. I have the same thing going on in HubSpot, like target company, right? I'm going through the same process on the other side. We're talking about deals, kind of looking for consensus at a partner meeting, like who's the right partner for me to pitch this deal with, because Matt knows this and Corey knows that, and she's really good in healthcare IT, and I don't really know healthcare IT. So concurrently on our side, all the VCs are like, hey, did you see that deal? Yeah, I kind of like that deal, right? So Cam at Ignition, Cameron will, he and I do a bi-weekly conference call, and once a month we go grab lunch. And he's like, hey, I saw this deal. It's too early for us, but I thought you guys might like it. Because if you guys like it, we would invest in it at a later stage. So what early stage VCs are doing is we're standing up deals for the bigger VCs. So the other thing you need to know about it is we're going to get diluted with you. So if we invest in a round where we invest $750 and we have 10%, and somebody comes in and writes a big check, in order to keep my 10%, I have to write a bigger check. So I don't want you to take any more dilution than you should, like, because we're getting diluted together. And because we're coming in early, it feels disproportionate. The math is the same, but it just feels that way. So no one's going to write a check from an exec summary. There you go. Yeah.
So earlier you talked about the pro rata
Yep.
preservation. That was within the context of angel
Yep.
investment. Is that also common for early?
99% for early stage VCs. Yeah. So the philosophy from the VC perspective is we're going to double down. So if you take the 25 investments, let me give you 100 math, just because it'll be easier math for me to do in my head. Of the 100 investments, 25 of them are just going to die. 25 of them are going to be so that's the fourth quartile. Third quartile are going to be zombies. Can't raise money, not really growing fast. You as a founder can't really leave, though I think you probably should. Right, because it's like the company's just kind of doing okay, right? So do we ever get our money back on those ones? Yeah, maybe. Second quartile is where I end up spending most of my time, right? Helping sales, helping marketing, helping you grow, right? Because those ones are like, from an internal rate of return perspective on a fund, those matter. And then first quartile companies, I write one check and I'm like, I want to write another check. And you're like, I don't need your money anymore. And I'm like, Dad, damn it, I should have wrote a bigger check, right? So the pro rata there says, as the company grows, I want to keep my percentages and write you a follow-on check and a follow-on check. The problem with a small fund is when you get to a B round of funding and you raise $100 million, I don't have enough capital in my fund to actually take the shares. So what happens with that is called a sidecar. So we basically say, hey, we have this killer company, they're raising their B round of funding, they're raising $100 million post-money value, whatever, a big number. The fund's not big enough to participate. We create what's called a sidecar. We basically form an LLC. It's an investment vehicle. We invite our limited partners to participate, and they write the check as a group and take our percentage. So we still get a 10% carry on that one. So for those of you who hadn't heard me talk about the math in the venture industry, our math is really simple. We take a 2% fee on committed capital. So if we raise $100 million, we get $2 million a year to use for expenses like office expense and travel, et cetera. Not generally big. So small funds have tough economics. It's just like you're really betting on, I'm betting your deal's going to work in 7 years because I'm not getting enough salary to matter, right? Then we get 20% of what's called carried interest. So after we pay back the $25 million, the next $1 million we get 20% of. But we have to pay back the committed capital first, or the actually paid in capital first. So that's the way the mechanics work on the fund. So my goals are really aligned with your goals to see you get to success and an exit. Where it gets a little weird at the end is a fund is 10 years plus 1 plus 1. So if I invest in your company in year 6 and you're hitting your stride in year 7, then I'm at my end of fund life. And I kind of want to get my exit because, you know, Devlin he's like, dude, you said it was 10 plus 1 plus 1. It's time for me to get my capital out. So that's why what you see with most funds is we raise funds in year 1. Year 2 and 3, we deploy 75% of those funds in year 2, 3, and 4. And then you're out raising the next fund because I have to have time for it to mature. So yeah, the big ones, we want to keep our pro rata you'll always see us keeping pro rata. So, and terms are pretty much, if you have a good lawyer, terms are pretty much vanilla terms. Every once in a while you run into a deal, you're like, that's weird. And weird deals we just tend to walk away from because it creates too much risk factor. We talked about junior associates. By the way, there's managing partners, general partners, and venture partners. And basically they have different fiduciary duties with the fund. So managing partner manages the business. They're kind of the CEO equivalent, but it's a partnership, so it's weird. General partners are typically people who are out raising capital. So I came in and this one is a venture partner. I'm just sourcing deals. That's what I do. But I don't raise any money because I'm like, maybe, right? So, but it's kind of a deal sourcer. But for me, that actually works for what I do. All right, due diligence process, couple quick, and then we're getting ready to wrap, and I'll leave it for some ask me anything stuff at the end. So what happens concurrently then internally is we write a deal memo. The deal memo gives us a checklist of things that we walk through from a process perspective so that when Dan says, hey, why did you invest in that deal? Can I see the deal memo? I can actually produce it for him and say, here's our due diligence document and documents. We go into, there's a link here from a post. You will create a data room. That data room will be on Dropbox or Box.net or a couple other tools. And basically you're going to put all your corporate docs there from the very start. Here's our incorporation documents, here's our employment agreements, here's our assignment agreements. And the reason you do that is because when we get excited to write you a check, I'm going to be like, hey, can you send me access to your data room? And you're going to be like, what's a data room? And a data room is just where all of your financials have sat, all your corporate docs have sat, all your contracts, all your employment agreements are all there. There's a checklist of everything that goes in the data room in that link. So I will save you from the legal ad nauseum. What we're doing in the investment memo and the due diligence is I'm proving to Dan that I have made sure that you were actually incorporated in the US, preferably in Delaware, not in Cyprus, and that we were investing in equity, not in coins or tokens, right? So I'm going through a checklist to make sure that I don't miss anything. And there's nothing quirky, and you're like, so one deal from personal experience was a friend of mine's company. The IP from the founder never got assigned to the company. So the patents actually belong to the founder and not the company. Dough. It kind of impacts the enterprise value. So what are we investing in actually? If we don't have any intellectual property, that's kind of a problem. One of the things we're going to ask you to do is we're going to ask you to do customer calls. My recommendation, and this is again me being founder friendly, where it makes VCs anxious, is you say, that's awesome. Typically at this stage, you don't have a lot of customers. You don't have 100. So you can't have 8 VCs call your 3 biggest customers without the biggest customers going, is nobody investing in this? Maybe we shouldn't be a customer, right? So my recommendation to you is that you say, awesome, Dave, I'm happy to have you call my customers. Is that the only thing you have left in due diligence before you write a check? I just think it's fair. Because the answer is, no, I got this other stuff I need to do first, so let's hold off on doing customer calls until I do this other stuff. And then you have somebody who's not leading the round saying, can I do customer calls? And you're like, well, we actually have a lead. Dan's our lead investor. You can talk to Dan about the customer calls. Or you're writing a super small check. The answer is, well, you're writing, so you're going to say you're writing a super small check. You shouldn't write it. But just be aware that you don't want to have a customer flip and churn on you because you took so much of their time doing demos with your investors. Not good protocol. Then we're going to meet with other investors. We're going to meet with who invested in you early. We're going to meet with who invested in you next. We're going to help syndicate the deal. So we're going to help try to pull the deal together. And by the way, until the check's in the bank, it's not actually a commitment. So I have a deal memorandum. I have a term sheet. A term sheet then goes to a definitive agreement. If in the syndication something weird happens, I'm probably not going to be your investor, depending on how weird it is. So you want to disclose bad stuff fast. Concurrently to that, you need to do due diligence on the fund. Can I talk to some of your CEOs? What would your CEO say about you? Can I talk to a deal that you passed on? This is a long relationship. Like, we're going to be hanging out together for like 7 to 10 years. You better make sure that you've done due diligence on the other direction, just so you know. And those are some questions you can ask. You can pull this up when it's time appropriate. My last point there is all money is green, but not all money is good. So, and there's plenty of war stories that go with that one. Just know that's why you want to ask their CEOs questions. So finally, some tactics as we conclude. Create a momentum to close, right? And a reason. If you keep making your numbers and you're booking revenue and momentum, you're probably in great shape. If you, after you close a deal, there's kind of everybody goes, oh yeah, the first board meeting after you close the round is usually met with like, oh, you had a customer churn. How come we didn't know that? Or oh, so like you don't want any things to be surprises. So just be aware that you want to keep your pace on into what you're doing, and I'll throw this into the do's and don'ts perspective.
So
Yeah.
what is that second bullet with it? Features shipping next month is a reason to.
It's a reason to wait. Sorry, not weigh. It's a reason to wait. So if you give me a reason to wait, I will de-risk and find a reason to wait. Some final do's and don'ts. Do keep your eye on the ball. Don't miss your numbers. We're doing this. Sales is going the right direction. I got momentum. And then you're like, all of a sudden, we missed our forecast. What happened? Oh, we were so busy fundraising. Ooh, not a good reason to miss your numbers. Like, bad reason to miss your numbers. You manage the process. You need to qualify the investors, and you need to create optionality. Don't get less than 6 months of capital in the bank, which for most of you are so early. It's like, well, we've had less than 6 months of capital in the bank forever. I've lived with that one too. Don't hide the ball on any bad news. Don't be too transparent. Like, once somebody writes you a term sheet, you're like, it's awesome. I've been pushing this, but nobody wanted to say yes. Totally needy relationship, right? You're like, oh, swipe left, swipe right, help me. So don't be too transparent, right? So there was a fund recently got some PR because they're giving 1% of their cash for mental health and coaching. And I'm like, I think we spend way more than 1% on mental health and coaching for founders. Because we talked about before, for those of you who knew, 80% of startups fail, which you all know that doesn't apply to you, right? Because you're here. And then I think I can pick better deals than other VCs. So I have delusion chasing delusion. It's amazing, right? So, and then don't let the investors off the hook. So I had a deal I know that they had a close, they had an agreement to buy, they were running out of cash. There was a commitment that was required to put in the bank as an escrow, and they kind of did the hand wave. They're like, no, I trust you. And then the buyer was like, they're going to run out of money and not make payroll. We're just going to drag our feet. Yeah, it happens. So don't let people out of the commitments they have. Broad funnel. Just a couple notes here. Just know that time kills deals. Like, if you create reasons and time to close, great. If you don't have momentum, go find another lead. Go find another investor. You also need to know what you're going to do with the capital. It's called use of proceeds. So how much capital do you need to raise? What are you going to use it for? How far is it going to get you? What we care about is not that, oh, this will get me out a year, which when I hear that, I hear, I need to get paid a salary for the next year, so I need to raise this much money to get paid a salary for the next year. I don't really care about that. I care about how many milestones you're going to hit. This is going to allow us to get $1 million in revenue. This is going to allow us to get X number of people hired. This is going to allow us to ship X number of features. So think about it in terms of milestones. That what are you going to get me as an investor? I'm going to hit these milestones for this cash. Great, because we know you're going to go raise more cash. That's fine. You don't have to get to cash flow break even. I want to know what milestones you're going to hit that are within your control. Okay. All right. Next session. Before I go there, questions. This qualifies as the what's the Ask Me Anything section about fundraising. Yeah.
So when I went on Crunchbase, I saw what companies that were similar to mine were seeded for, but I didn't see what percentage they got. How do I get that kind of information?
So the question was, I went on a Crunchbase, I saw some companies like mine and how much money they got, but I didn't see what percentage they gave up. So you won't find out unless you ask them specifically, but you have to assume it's 20 to 35%. So if you go back to the back of the napkin one and they raised $1 million, you're like, yeah, they probably got a $4 million post-money value because they raised $1 million. I'm in the ballpark. And generally speaking, you'll be in the ballpark. Yeah.
So, as an investor, would you prefer, the early stage, would you prefer that I do a later stage so that I can grow faster and exit sooner, and with you having that increased dilution? Or would you rather, oh, well, he takes 2 years longer, but I'm not diluted again?
So it depends on the market timing of the deal, because typically it's not in a vortex of just you and alone. It's like what's happening competitively in the market. So I'm sorry, the question was, would you rather I take your money and not take future dilution in a bigger round, or would you rather, and take 2 years to do it, or would you rather I grow faster? So a lot depends on where your market conditions are, and if you're in a market that is hot, then the answer is take the money at terms. So the founder's answer to this one is take money at terms you find agreeable, right? But know what you're going to use the money for. Like one of our portfolio companies went out and raised 25, and a year later they have 25 in the bank. And I'm like, that was expensive money. Like you didn't really need to raise that. Like it's good, like it made me feel comfortable and I have a war chest, but it was like, yeah, it's expensive money. If they have a chance to rethink it, would they? I don't know. That's kind of up to them. But I kind of look at it and go, listen, if you don't have to take the dilution, don't take it. At the same time, if you're like, I know how I'm going to use the money and I know how I'm going to spend it and I know what kind of return I'm going to get with it, the answer is take it. So take it slightly more than you need. So other questions? Yeah.
Going back to the Moss example that you put in their book.
Yep.
They're actually paying dividends and they're creating a different atmosphere of funding.
Yep.
Do you have any feedback on either that model or?
Yeah, so the reference is Rand Fishkin wrote a book called Lost Her Founder. If you haven't read it, it's awesome. I love Rand. It's a great guy to hang out with. So they're doing a different model that's non-venture. So they're doing an LLC and they're taking investors, individual investors. And then, so we, as a VC, we don't actually have the mechanic to take dividends. Like if you had a dividend and you're like, where should I send the check? I'd be like, we can't take it. Which sounds really wacky, right? Because all we really care about is that you exit on a huge multiple. Right? Don't send me money, double down that money and get bigger growth. Now, when you think about it, that's totally whacked. So Rand's new model, and by the way, he's open sourced those docs with Joe Wallen from Carney Law. It's very similar to I don't know if they have a GitHub account, but very similar. They've got it all out there. He's raised money with a sense of, hey, we're going to pay ourselves a market rate, and we're not going to pay ourselves more than market rate without approval from the board in advance, and we're going to pay dividends. And I think it's great. I think he's, I had a female founder I know well whose response was, well, yeah, he's effing Rand Fishkin. The answer is, yeah, and, right? I mean, but I like the model from the standpoint of, do you need to take, when you take money from a venture capitalist, you're taking on our revenue model, right? So I have a 10-year window. If you're like, we need 12 years, I'd be like, don't take venture capital, right? I'd rather you grow slower because I have fund shareholder expectations that say at the end of this time, I need a liquidity event. So you just have to be aware of where that where your motivations and the VC's motivations differ. So you're going to ask.
It's about grants and non-dilutive funding.
Okay.
My area is in mental health,
Yep.
around people that have been in prison or serious trouble. And I didn't want to, Mr. Soto, Javier said, don't take money too early because it's expensive.
Yep.
So I went and chased grants. The problem with grants is you have to use it for specific things. So should I digest the grants first to make our model and our technology and publish and that sort of stuff work? But what I want to do is build tools and apps.
Yeah.
How do I deal with that? Does winning, say, $250,000 in grants and
As long as the reporting, so
or
the
is it really just a
Yeah.
discrete sort of solve that problem, digest that first, and then talk to the VC? I mean, it's a fun problem to have.
Yeah.
But it's
So the question there is one of using grants to build product that gets you to certain milestones.
Yes.
And the concept there is generally non-dilutive capital. So if I have a chance to get capital as non-dilutive capital, the question is, does it keep me on my game or not? Or does it move me off true north? Right? So what this typically happens in the services business where I'm building a product and I have a customer who wants me to build the product that's just a little bit different. And if it gets you to the same end game, the answer is fine, great, build a product. That's how SEO Moz actually started. Was they had a services business that built tools and they sold the services business. That 35 to 50% gross margin business tends to be pretty addictive. So because it generates good cash, but it doesn't generate a business that's like highly scalable.
yeah. I'm trying to use grants to solve that problem.
Yep.
Because I didn't want to get distracted. But
Yep.
anyway.
It's the flip of the coin, right? You get both sides of it. Other questions before we go? Yeah.
What are the general feelings in the early stage investment community about a safe versus a convertible?
Yeah, so convertible note versus a safe. A safe is a mechanic, which is basically you're making an offer to sell future equities. So I'm missing the first part of the acronym. It was created by Y Combinator. It's pretty standard as the case. You'll have a bunch of angel investors who don't know it and a bunch of who have a preference for debt just because they know it. But when you explain what a safe is, we like safes. It's the same mechanic without having. Right now, if you do your QuickBooks, you have debt that shows as debt on your balance sheet. A safe doesn't show as debt on your balance sheet. So the problem with debt is if I'm part of a $1 million debt round and you actually crush it, you can actually pay me back with 6% interest in 2 years and I never own any equity. As an investor, I don't actually want that. I actually want to, especially if you're killing it, I want to own equity. But getting debt in is really cheap. So instead of having to do a disclosed round, an SEC filing, and a Reg D filing with the state, I can just do that. The risk there to me is to make sure that if you kill it, you don't just go, hey, by the way, here's your $1 million back. I'm like, what? I wanted equity, right? That's kind of a bummer. Yeah.
Wait, so about that. So
Yep.
Is that a standard thing where so you take $1 million loan and then how many years do you have to pay it?
Typically it's 3 with 6% accrued interest. And what typically happens, the intent of it, though not the law of it, the intent of it is you then raise a round of funding that prices it. So you're selling equity then. So then I take my debt and I convert it to equity at the price or at the discount level of the next round, right? But you could, if the company was generating cash flow and you're like, I have $1 million, I could pay him back, you could legally give me back that $1 million plus the accrued interest and not give me any equity. Which is, as an investor, I'd be like, that sucks, right? Because you're killing it and that's why I took the risk with you. But the legal docs do allow you to do that.
Does SAFE change that?
A safe does change that because you're basically committing to sell equity at a future price.
So SAFE sounds like it's a better, more attractive for an investor.
So yes, but it's less known. Like in the Valley, it's very well known, and all the Y Combinator companies only use safes. So both are easy to do. You may have to educate angel investors on a safe. I prefer a safe because you don't have the. There was probably 8 or 10 years ago, there was a bunch of convertible debt that wasn't getting converted, and you're like, I have this huge overhang of convertible debt that's not getting priced, and they're just raising another debt round, and it's like, yeah, that's just weird. Like there's a risk factor there. So yeah, so preference would be a safe as long as your investors know what it is. Okay. All right, last one, and then I'm going to go to some. Go ahead.
So you've talked to us about pitching for angels and VCs.
Yes.
What can you tell us about pitching to
Great question. Okay, so what can you say about pitching to accelerators? So a lot of the same mechanics you're going to do from a doc, executive summary, PowerPoint, all those things are the same things. You're typically going to use 90% of the accelerators use a tool called F6SES. So the letter F, the number 6, and the letter S, which stands for Founders. It's a firm out of London. So Techstars and 90% of the accelerators worldwide use this application. You basically go and build a profile, you upload a video. Techstars will take, I think the last one I did, they had 400 companies apply. We evaluated 60 to get to 10. So they filtered out the 340. We screened 60, then we got to 10 companies. So the hack there is knowing who's doing the screening, if you can, which is tough to know. But F6S is usually the process they use to do that. You'll use a lot of the same mechanics, and you want to make sure your positioning is the same thing. And I would say, again, like we do as a fund, we would over-index on, is the team great and is the market big? And like we've talked about in previous sessions, if you're pivoting around your problem and not trying to find a problem around your product, that's a big deal, because it's like, yeah, we know you're going to be off, but if it's a big enough market, you can have multiple chances. If you're off and it's a small market, the answer is, yeah, there's not a lot of chances to take with that. So same mechanics, same process, just know that your filtering process is a group of people who are looking at 10 to 15 companies the week immediately prior to they do the selection. So yeah, it's actually a fun process to do.